Hey everyone, welcome back to the channel. It seems like Canadians are growing more frustrated by the day and wanting to leave Canada. You see various news articles online saying that Canadians are fed up with taxes, amongst other things. Now, personally, I love Canada, but I do agree that the taxes are high in comparison to other developed nations. Before you consider leaving Canada, you have to consider what the implications are of doing so. For instance, are you leaving friends and family behind? Will you be selling your personal assets such as your house? What is the cost of living in the new place that you're going to? What job will you get when you go there? One important aspect that people often overlook is the tax consequences of leaving Canada. In other words, how much will it cost you to pack up and leave? Will your after-tax dollars here in Canada be enough to purchase a new home in the place that you're going to, such as the United States? Now, let's dive in and make sure you're aware of some of these tax consequences. The first and most important aspect is to consider your tax residency status before you leave Canada. Your tax residency status simply means what income will you be taxed on in Canada going forward. Now, the CRA considers different factors in your tax residency status, such as, do you still own a home in Canada? Do you have family connections? And also, what is your intent? Are you intending to come back to Canada? They'll look at all three factors to determine whether you're still a resident of Canada for tax purposes, and therefore need to file a Canadian tax return. You may be considered a resident, a non-resident, or a deemed resident for tax purposes. As a resident, you're taxed on your worldwide income. As a non-resident, you're only taxed on your other Canadian sources of income. So if you leave Canada and you sever all your ties, as I previously mentioned, you sell your house, you have no intention to come back, and you have sort of no connections with Canada, then you'd be deemed a non-resident. For example, let's say you're moving to Australia for a new job. If you sell your house in Canada, cancel your health benefits in Canada, and establish a new home in Australia, you might be considered a non-resident. However, if you keep a home in Canada and you continue to visit, for instance, then you could be still considered a resident and taxed on your worldwide income right here in Canada, which means you'd be still considered a resident for tax purposes. Now, if you're considering leaving Canada and severing ties, it's wise to file a form called the NR73 to determine your residency status with the CRA. When you leave Canada, you might face what's called a departure tax. This tax is essentially a capital gains on assets that you own in Canada. The departure tax applies to your worldwide assets, as if you sold all your assets on the day you cease to be a Canadian resident. Now, assets that are subject to the departure tax include real estate, investments, stocks, and other property. You're also deemed to dispose of these assets at the fair market value, which could trigger a capital gain. For example, let's say you own some stocks that have appreciated about $30,000 to $50,000 since you bought it. On your departure, you're deemed to have realized a capital gain of $20,000. So you'll be taxed on that appreciation in the form of a capital gain. Any real estate holdings that you have will be subject to capital gains tax when you sell it on departure. Now, foreign income such as wages earned in a foreign country are generally not taxed in Canada if you are no longer a resident. However, you must report Canadian investment income such as rental properties, stocks, bonds, or other investments of that matter. For instance, let's say you move to the United Kingdom, you still have a rental property right here in Canada, so you'll be required to continue to report that income. Number 4, managing Canadian assets. Now, deciding what to do with your Canadian assets when you leave the country is actually very crucial. So any real estate holdings that you have will be subject to capital gains tax when you sell it on departure. The same goes for investments as well. If you decide to sell a property in Canada, you need to report the capital gain on your final income tax return in Canada before you leave. If you keep the property here in Canada and decide to rent it out, you'll still be required to file a Canadian tax return and report it to the Canada Revenue Agency. Number 5, double taxation agreements. Now, to avoid being taxed twice on the same income, Canada has various tax treaties with other countries that help to prevent this. Tax treaties have a mechanism for providing for a tax credit or exemption for taxes paid in one country against another. This can help prevent double taxation on things such as wages, interest, and dividends. For example, let's say you move to France and you earn employment income there. The Canada-French tax treaty will help prevent you from paying double tax on the income that you earn there. Now, each of these aspects requires careful planning and consideration to ensure you meet your tax obligations and make the most of your move. If you found this video helpful, please give it a thumbs up, like, and subscribe. Thanks for watching, and we'll see you in the next video.